and welcome to this episode of China Edge, brought to you by the SupChina team. I'm your host, Lizzie, an MIT-trained economist turned journalist at Wall Street TV who covers China and its relation to the world. Here at China Edge, we go beyond the headlines and guide you, our audience, through the jungle of Chinese regulations. We go deep into industry trends and identify challenges and opportunities in the Chinese market. Join our conversation every week for interviews and analysis with the most knowledgeable minds on China. Also, stay tuned for special future episodes with Kaiser Kuo, host of the Sinica podcast, and Jeremy Goodkorn, editor-in-chief of SupChina. Joining me today is Ms. Li Tianzhen, director of Modern Alpha at WisdomTree Asset Management. Li Tian will help us understand the market-moving news in the past few days or even hours. Li Tian, thank you so much for being here with me.
Thank you for having me, Liz.
So, Li Tian, just this morning, we saw the Reuters report that China's central bank has rumored to agree to greenlight Ant Group's application to set up a financial holding company. So help us understand that piece of the news. Should we expect a rollback of regulatory crackdowns, or are you still not so sure about that?
It's extremely premature to talk about Ant IPO. Extremely. So I think for Ant, it's long road toward IPO. I would say it's not normal to have so much rumors that's driving the market. If you look at what PBOC wants Ant to do, even this morning's report, first, it's not yet confirmed. The second, even if it's confirmed, it's PBOC accepting its application. It's not approval of the application at all. So, and even after they're approved, from there to IPO, there's still significant road ahead for Ant. I think PBOC has been very clear what the kinds of things Ant needs to do, and has done it. Some of it, like for example, separate the credit scoring portion of the business. But the other questions still remain. For example, what leverage is going to end to be able to control its financial risk? How can it demonstrate it won't be a systematic risk, financial risk because of the outreach that Ant has in China's financial market. There was a corruption case in Zhejiang that even though the person has already been sent to the legal system, and it's very murky. But if you look at through the between the lines reporting on that corruption case, it's not clear that Ant is completely cleared from that. So I think it's extremely premature. I'm a little bit troubled. There's so much rumor-based news, and I felt even for journalists, you got to be very careful with these kind of news that's moving the market, and you wonder, who is behind, because it's significant impact on China equity.
Risks. I want to turn to the other part of regulatory risks, which is the potential of Chinese firms being delisted from U.S. stock market. So what's your take on that rumor or that news on progress made between sort of regulatory bodies between two countries?
That's another area. A lot of news media has been, a little bit lax in just reporting on progress. But actually, if you look at what SEC and what they have seen, there's no significant movement of China moving toward satisfying the U.S. law, which is already a U.S. law. So there's not that much leeway that the U.S. side can do. For that, as a portfolio manager, I have to say in the large and mid cap space, about 95% of companies, really, among the top, 500 larger companies, the number of stocks that doesn't have a dual listed Hong Kong share is very low. It's only less than 30 stocks that doesn't have a Hong Kong dual listing. So for me, when I manage a portfolio, we've in the last 2 years, ahead of most of the competitors, that we've moved U.S. listing companies shares to Hong Kong shares because the liquidity of Hong Kong shares has already increased. So for individual investors, you really want to be looking out because if delisting happens, which is still highly likely, you will be a little bit, holding the bag if you don't transition, if your broker firm doesn't transition seamlessly to the Hong Kong shares. For our investors, because we're doing it as a ETF, so they don't really see it. When we move to Hong Kong share, it's seamless to a typical ETF or mutual fund investor. So that's another area is the positive news is getting ahead of the reality right now.
Right. Well, thank you so much for that insight. Very important to keep in mind. Speaking of positive news, I heard one theory goes that the relaxation of regulatory pressure really is Beijing's way to signal it's being serious about supporting its economy. But what about zero COVID policy? The U.S. ambassador to China, Burns, said yesterday actually he expects Beijing's zero COVID policy to persist into early 2023. That's next year. Is the party going to wind down the zero COVID policy? What are the signs you have noticed reading news from China?
And I think, Ambassador Burns is a good person to listen to. and she's been active on Twitter, and some of the things he highlighted on China is very interesting. I highly recommend people. I myself, follow him, sometimes read what he reports. And that's another area I think what's on the ground is really important to understand what's going on in China. On the ground, really two things. One is most people still support COVID zero. That is something which is even after Shanghai. I know it's hard to understand for a lot of people outside Shanghai, China, but a quick way to see it is that even if China is 100% vaccinated, even if China's healthcare system is as good as Singapore, which it is not, the death rate is about 0.04%. That translates to about 160,000 deaths for China. And considering right now there is a presidential election, we don't call it an election, but China is having the equivalent of a presidential election going on in 6 months. So for the president, I don't think he's interested in having a headline of 160,000 deaths, right? Not even in the US, if you think, and no candidates want to deal with that kind of headline. So I think before the October Party Congress, unless it becomes so costly, then China will relax. But if it can still maintain COVID zero until in October, it will definitely maintain it. And it's looking at how the economy is bouncing back in the next couple of months to make a decision. And the second is even after October, there's still lots of infectious disease experts who have influence on the government's decision. Even they still saying, potential another wave. So it's not clear that the public opinion will shift quickly. But in the end, I do believe China will open it because if you look at the very little signs, there's incremental signs that's happening, such as allowing family visit visa starting, this week from US as well. And the quarantine days used to be 14 days in hotel if you visit China. Now it's 7 days for several places, and I expect that to be even lower, to closer, maybe like 4 days. So I think ultimately China is going to open, but it's going to be at a very lower speed than many people. And I think Ambassador Burns' take is pretty on point.
Right. It's good to listen to the ambassador who's currently in China on the ground and observing things happening. But how bad is China's economy going to be? I want to turn to a set of new forecast adjustments on China's macro prospects. Actually, in a report to clients on Friday, Bank of America cut its forecast for Chinese growth to 3.5 percentage point from the previous 4.2 percentage point. UOB yesterday lowered its forecast to 4.1 from 4.9%. And economists surveyed by Bloomberg had a median estimate of 4.3, which is well below Beijing's target of about 5.5 percentage point growth. Do you think the GDP growth target 5.5 percentage point is still in the cards? What should we expect, given your expectation of how zero COVID is going to persist?
The 5.5 is absolutely not in the card. I think pretty much even government itself already knows that's not achievable. But 3.5 or 4% is still potentially achievable. So China is not going to scrap the 5.5 target. It, if at the end of the year it does achieve actual growth of 4.4, 4%, which would be lucky if there's no major global recession and no major outbreak. Then China's, statistic bureau is likely do a little bit data smoothing, which they have done, consistently to make it probably like 5%, and then say the 5.5% target was set before the Russian invasion of Ukraine. So understandable that the growth rate is lower with energy costs. So that's the much more likely scenario. China, the investment numbers in China is extremely, I would say, not very credible. Particularly investment, even outside China, investment is a statistic that's harder to measure, and investment is a big part of China's GDP. Unlike in the U.S. consumption, which is easier to measure than investment. So I think if China can achieve 3.5 or 4%, in reality, on paper, it's likely look like 5%.
Right. And you also talk about the importance of this year in terms of China's political calendar. So let's talk about that. What policy initiatives should we expect in the lead up to the 20th Party Congress? What's the implication for investors in the China space?
Actually, very little. I think currently, probably everybody at the top is focused on who's going to be whom, who's going to be the next prime minister, next. So all the gossip, all the energy is going to be focused there. The policies are unlikely to change much. So essentially, tax cuts. China is very, in some way, much more capitalist than in the U.S. There's no direct money for individual, nothing, specific like, $1,000 for the poor. Most of the economic stimulus works through the supply side, essentially reduce tax, reduce some of the fees, delay tax. Those are the economic policy that's going to continue. The other the other is try to contain the COVID restrictions. So, for example, during Shanghai wave, a lot of highways got closed by the provinces. And Vice Premier Liu He, he is leading the logistic portion, making sure the logistics flows across provinces. So these things will continue. And obviously, in government's investment in new energy, new up and coming, like a data center infrastructure, those investments will be put it in. But I wouldn't expect any big bang economic policies. COVID is the economic biggest factor, how much COVID impacts consumption. Just yesterday, some of the poorer places is getting rid of the so-called routine PCR tests, because if everybody has to get these PCR tests, not only the local government has no money to pay for it. Many local governments, half of their budget is coming from the higher level of the government, and the health fund says we're not going to pay for those PCR. So the poorer local governments are not going to be able to, continuously do the PCR test. So a lot of these things on the margin could impact consumption, but I don't see big bang economic policies.
Right. So no big bang in terms of economic policy, not much surprise, but we generally know the direction. Is there any chance of big bang in terms of political leadership reshuffle? For example, there has been this rumor on the rise of Chinese Premier Li Keqiang. Is there anything to that?
I don't believe this at all. First, I don't really research politics. My day-to-day is much more focused on companies and their earnings. But this year is very important, so I try to read up on politics and talk to experts. And just from a layperson's point of view, I think Premier Li, he is worried about his own legacy, so he wants to show that he is, doing the final round. But actually, even from the equity market reactions, you can see that he doesn't have that much power. He is a premier, but when he, came out and do some of the policies, the market sometimes react, sometimes, doesn't really react that much. But if vice premier who Liu He says something or leads a conference, the market it went through the roof. So you can see that even though Liu He is a vice premier, but his impact is on the market is bigger because people know that he has more power to push through things. That's why, what President Li Keqiang's policies like tax cuts, spending the money that the central government has quicker, these doesn't require lower level political capital, which he doesn't have those. But Liu He is leading the logistic portion. He is essentially highlighting the provinces who are not doing their part. And under his workshop, actually the logistic situation has improved, significantly last month. You can see that, who has the political power on the ground to get things done.
Fascinating observation. Liu He is called the economic czar by Xi Jinping, Xi Jinping's right-hand person. So we do see that kind of market-moving ability coming from Liu He's side. Absolutely. So we've heard this phrase, 国计民退, the advance of the state and the retreat of the private sector. What's your take on that? Is that true? Or is there a more nuanced version of that statement?
Yeah, so that's another area. I think most Chinese, at least for people like me who are looking at the companies, is extremely aware of this narrative. Because our index only invests in private Chinese companies, not state-owned companies. I think there it's really more nuanced. When China is in a little bit economic downturn, the government, the financial market is not very efficient. So most of the capital is pushed through the state-owned banks and then state-owned enterprises. So they do get cheaper credit than private firms. And in the downturn, the state-owned companies indeed do better. They make more money. And secondly, when commodities do well, because the state-owned energy firms dominate by state-owned companies, and in last 2 years they've just like the U.S. Energy firms or the Chinese energy firms are also made significant profit. But over a longer run, usually the cycle works that the state-owned firms kind of take a little bit first dip in cheap credit, and when the economy turns better, then the private firms really shines. So over a very long run, I still believe the private firms will do better than the state-owned firms. But this is area I think for investors, they could pay special attention. If indeed China is getting back to the state-owned business, if the number of people working for is significantly moving toward state-owned over 5 or 10 years, then it does make China equity less appealing. Because the strength of China economy is its private business. It's not its state-owned business. But as of now, at this moment, because of the commodity boom, because of cheaper credit, the state-owned businesses were able to do better the last year and year to date.